In 1990, Enron was a natural gas pipeline company nobody'd heard of. By 2001, it was worth $70 billion. Then, in 6 weeks, it evaporated. The story doesn't start with fraud. It starts with deregulation. In the 1980s, the natural gas industry began to open. Pipeline companies that had operated in safe, regulated monopolies suddenly faced competition. Enron was founded in 1985 through a merger. It inherited pipelines, it inherited debt, it inherited a culture of survival. By 1990, Enron's leadership decided pipelines weren't enough. They wanted to trade energy contracts the way banks trade stocks. They wanted to be middlemen. They wanted to move fast. A man named Jeffrey Skilling joined the company that year. He was a McKinsey consultant. He believed in one thing: growth, measured quarterly, reported without apology. Skilling brought an accountant named Andrew Fastow. Fastow's job was to make the numbers work. Enron's energy trading business had a problem. It was volatile. Profits swung wildly month to month. Wall Street hates volatility. Wall Street rewards consistency. Fastow found a way to deliver it. The tool was called mark-to-market accounting. Here's how it worked. When Enron signed a long-term energy contract, it didn't record the actual profit. Instead, it guessed what the contract would be worth at the end. If the guess was optimistic, it recorded the profit immediately. The money hadn't arrived yet. The contract might fail, but the profit was on the books today. This wasn't illegal, not quite. It was aggressive, but the rules allowed it if you disclosed it. Enron did disclose it. The fine print was there. Nobody read the fine print. Analysts looked at the headline numbers. The numbers looked perfect, quarter after quarter, year after year. By 1998, Enron's stock was climbing. The company's culture became intoxicating. Executives earned bonuses tied to quarterly earnings. The more aggressive the accounting, the bigger the bonus. Young traders competed to book the largest imaginary profits. It became a game. The game had rules. The rules were invented by Fastow. Fastow created something called special purpose entities, SPE. These were shell companies. Enron would sell its worst-performing contracts to the SPEs. On Enron's books, this looked like a sale. Revenue went up. The debt went to the SPE. The SPE was off the balance sheet. Invisible. The SPE's funding came from banks that trusted Enron. They trusted the stock price. Here's what nobody understood yet. If Enron's stock price fell, the SPEs became underfunded. The debt would come roaring back onto Enron's balance sheet. The whole structure would collapse. Enron needed the stock price to keep rising forever. It was the only thing holding it up. August 2001. Sherron Watkins was a mid-level executive. She wrote a memo to Ken Lay, Enron's chairman. The memo was 6 pages. It outlined the SPE scheme in plain language. She called it a house of cards. She said it would explode. Lay read it. He did nothing. He asked Fastow about it. Fastow assured him everything was fine. October 2001. Enron announced a loss, the first real loss. The stock started to slip. Analysts began asking questions. The company's answers didn't make sense. The SEC opened an inquiry. The stock kept falling. Now the SPEs were in trouble. The debt needed to come back. Enron couldn't absorb it. November 2001. Enron admitted the SPEs were underfunded by over $1 billion. The company had hidden $1 billion in debt. The stock collapsed. It went from $90 to below $1 in weeks. The employees who'd bet their retirement on company stock lost everything. Some had life savings of $50,000. Now they had nothing. December 2, 2001. Enron filed for bankruptcy. It was the largest corporate failure in American history at that moment. 16,000 employees lost their jobs. The company that had claimed to be worth $70 billion was worth nothing. The auditors, Arthur Andersen, had signed off on everything. They'd missed it, or they hadn't wanted to look. The investigation took years. Fastow pleaded guilty to fraud and conspiracy. He served 6 years in prison. Skilling was convicted of fraud and conspiracy. He served 12 years. Lay died of a heart attack before sentencing. The executives who'd created the game walked away with hundreds of millions in bonuses and stock sales made before the collapse. Arthur Andersen, Enron's auditor, was charged with obstruction of justice. They'd shredded documents. The firm that had existed for 89 years was destroyed, not by prosecution, by reputation. Clients left, partners fled, the firm dissolved. One bad decision, one client, one moment of choosing profit over integrity, and it was gone. The Enron collapse changed corporate America. The Sarbanes-Oxley Act was passed in 2002. It required stricter audits. It required CEOs to sign off personally on financial statements. It created the Public Company Accounting Oversight Board. The rules changed, but the incentives didn't. Quarterly earnings pressure still drives behavior. Stock bonuses still reward short-term thinking. Enron didn't invent fraud, but it industrialized it. It turned accounting into a weapon. It showed that if you're smart enough, if your auditors are complicit enough, if your stock price is rising, you can hide almost anything. For a while, the while lasted 16 years, then it ended in 6 weeks. The lesson wasn't new, it was just expensive. Greed works until it doesn't. Growth is a drug. When the dose isn't enough, you invent a bigger one, you create special purpose entities, you mark contracts to fantasy, you hide debt in offshore shells, you believe your own story, and then you believe it's too big to fail. Enron believed that too. Subscribe. Each week, we examine the mechanisms of financial collapse before the warning signs become rubble.